So it's so nice to be here again. As mentioned, we founded the Smart Investor in January 2020. That also happens to be the last time this event was actually held live, right? And I'm so happy today to be among ourselves, a tribe of like-minded people who decided to come down on a Saturday to spend time on something you're passionate about, which is investing. Which is why, since we're doing this after 3 years, I thought I'll say just two things about myself. I see a lot of our members in the audience as well who have been supporting us for more than 10 years. Thank you very much for being here. But there are also new people. So here's just two quick things about myself. So I founded the Smart Investor together with my co-founders, David Kuo and Joanna. This was 3 years ago. We're still here, thankfully, after the pandemic. And back then, we didn't expect the pandemic to happen. And I'm really happy to be alongside people like David, who you may have seen on TV or heard on the radio, or maybe caught in a kopitiam because he really loves his Singapore food. Second thing you should know about me, prior to the Smart Investor, I spent time at the Motley Fool. So 7 or 8 years, various capacities. I got to work with the co-founder of the Motley Fool, Mr. David Gardner, and I served on one of his US services called Supernova. And that was when I was providing services to US citizens and, quite frankly, anyone who signs up for that service worldwide, right? So that's just two quick things about myself. But I want to turn the attention back to you, right? So we're all gathered here today. We are feeling a bit down after the stock market. If you're investing last year, the REITs in the Singapore market has been quite tough, right? US stock market has declined, especially the NASDAQ is down by 33%. So you might start to think that, man, this is quite a disaster, right? And I wanted to talk about disasters, right? And anyone seen this movie before? 2012? It's a very typical Hollywood fare disaster movie. I wanted to share just one scene, because it's actually quite a forgettable film. But there was one scene, just one, which I thought was so memorable. And there's a lesson behind it. So what I'm going to do is, I'm going to set up the scene, and then I'm going to deliver the punchline, right? So here we go. Well-dressed man walks into the room. He meets up with a wealthy billionaire from the Middle East, I assume Saudi Arabia, right? Hands him a dossier, and surprise, surprise, there's a disaster coming, right? But that's not too big of a surprise because it was a disaster movie. When you went in, you know you're watching a disaster movie, right? It's like walking in a steakhouse, you're not ordering a salad. You're going there for what you want to get. So the Hollywood has to bring up a second surprise, which is to say that, hey, there's an escape plan. Even though a disaster is coming, there's an escape plan, which is a bit more surprising. But again, this is Hollywood. You expect the happily ever after, right? It'll be quite boring if nobody actually survives and it's just a movie about people dying, right? Which is why the third surprise, after trying twice, the third surprise has to really deliver the impact, right? And that is when they say, yes, there's an escape plan, but guess what? It's going to cost $1 billion. $1 billion. Now that's the kind of number which makes you sit up and notice, right? If you're in the movie theater. But in a typical Hollywood style, just as you're being shocked, they deliver a fourth and final surprise, right? A fourth and final surprise. This is when it's so impactful that it makes me remember this scene 10 years later. So let me just recap. Well-dressed man walks into the room, tells him there's a disaster coming. Oh, but thankfully, there's an escape plan. But oh no, escape plan costs $1 billion. And that's when they uttered the most regrettable four-letter word, right? Most regrettable four-letter word, which is family-friendly, by the way. Four-letter word. And that is, just as you're reeling from the shock of the $1 billion, they tell you, I'm afraid that this amount is in euro. And that's the surprise. And now, I see some quizzical faces here because if you're quizzical, you must be well updated on the exchange rate of the US and US dollar right now. You may have spent a European vacation recently. But why this is a surprise is back in 2009, that's when the movie came out. The euro was trading at $1.35 to the US dollar. So the surprise was not only does it cost $1 billion, it costs €1 billion. So it's going to cost you 1.35 billion to save one person, right? What they did not count on was for this to happen. Last year, for a brief period of time, the euro was actually down below the US dollar. It was trading less than the US dollar. And that really tells you something, right? Because back in 2009, things were really bearish for the US dollar. People started questioning the position of the US dollar. Very much like today. Things are so bad, you feel down, you start questioning whether things are going to get better. And then, in 2022, the US dollar is actually at its strongest in 20 years. These are scenarios which you did not think about when you're in a situation where the news is almost always terrible. Whether it's inflation, there's China slowdown, there's the stock market crashing, there's the Ukraine war, and so much more. This is just a sample of the headlines. But as you calm down and you start thinking about what is happening, you start to realize that some of these things have already happened, because what I've shown up here is actually not from recently, it's from 2008. And some of this news will not look out of place if I put these headlines out today, right? This looks completely similar to what is happening today. Which brings the question, then if something has already happened, why are investors fearful today? Why are we fearful of investing in the stock market today? And I just wanted to share 3 numbers to define 2022, right? What was so difficult about 2022? We start with January. January was the month where 40% of the Nasdaq stocks had dropped by 50% or more, right? So if you invested in any stock within the Nasdaq, there's a 40% chance or 4 in 10 chance of you picking a stock which got cut in half. That was how bad, and this was just in January last year, the first week of January. That was how big this carnage was. A lot of people point to interest rates. And just to give you some perspective before I move on, this was as bad as the dot-com bubble, right? So that big circle you see there. And it's not as bad as the great financial crisis, but you can see that if you compare what happened last year with the previous years, you can see that it's quite an abnormal carnage. Now, a lot of people point to interest rates, which is true, but it's not just about how high the interest rates went, it's how fast it actually went up, right? So if you look at the last time interest rates were increased back in 2015, it actually took 36 months, okay? 36 months for the interest rates to increase to 2%. And last year, it took less than 6 months. So there's this humongous rate of increase in interest rates. It's causing all sorts of distortions. It's causing the US dollar to rise to its highest in 20 years. And it's this sort of distortion which is causing all this chaos, right? And as the final outcome, what happened next is you're being handed a rate report card more often. Now, this is a chart which shows the number of positive days within the stock market worldwide. And you can see that it's among the lowest it has been. It's comparable to the great financial crisis. And what this does is that it's like you're a school student and you're being handed rate report cards daily. And it's so frequent, and that is why I think that investors are fearful. As humans, we are really good at avoiding danger, right? If you step on the road, you see a car coming, what do? You step right out of the way. You don't think, right? You sense the danger, you see the danger, you get right out of the way. It's instant. You don't even think about it. Now, the same thing happens when you enter the stock market. You step in the stock market, you see a recession coming, what do? You move aside, right? And I think that's what is happening to the investors. So the real question is, what should investors do, right? And I think that right now it's really important to focus, right? There's so much noise about what's happening. I showed you so much news. It's really important to focus on the things which cuts through the noise and focus on the most important thing which will help you make gains. And to do that, I want to share with you a framework which I use to discern how a stock price behaves. Because a lot of people, they're looking at stock price, but the stock price is an outcome, right? It's an outcome of two key factors. To me, those two key factors, firstly, is the business performance. Now, you can use whatever measure you want to use. You can use earnings per share. I like to use free cash flow per share, right? This is the amount of money which the company generates over time. Now, this is one of the factors. The second factor is a matching ratio to whatever measure you choose. So if I use free cash flow per share, then you should use price to free cash flow, because if you multiply the two, you get the share price, correct? So very simple formula. Now, I want you to pause right now and think a moment about this formula and think about it as a mathematical equation, okay? So forget all the words, think of it as mathematics. So if the free cash flow per share goes up and the multiple does not change, what happens to the share price? It goes up, doesn't it? So if it's 3 times 1, it equals 3, right? 3 times 1 equals 3. If 3 becomes 4, 4 times 1 equals 4, right? So the main driver here then would be the business. Now, of course, the reverse can happen also. You can have 1 times 4 equals 4 also. And you can see that both factors have an equal impact on the share price itself. But that's where the similarity ends, right? Because the first factor, this is the business. This is what the manager can control. If the manager does a good job, they generate revenue. If they keep costs and expenses intact, they will generate cash flow, right? And if they do that consistent enough, they grow that free cash flow per share, that will help drive up the share price. Now, the second factor, unfortunately, is not within the control of the management. This is the multiple which the stock market awards to the share price itself. So we've seen that in 2020 and 2021, when the stock market was happy, what happens? They award a higher multiple. But when the stock market is sad, like 2022, they award a lower multiple, right? And this can influence the share price in the short term. And the key here is really the word short term, because I want to share with you as a final example of a share which I've owned for about 12 years, and that's Apple. I bought it in June 2010 for $8.75. I checked the stock price yesterday, it was 126. So it's actually gone up by 14.4 times. So if you've invested $1, it would be $14 or more. This is excluding dividends, by the way, which would actually bring it up even higher. But let's leave it out for a moment, because that's not my main point, right? The main point is about what is actually driving the share price for Apple. Now remember that there are two factors, and I'm using the same framework here. What is driving the share price? You can break down the 875 into two components. Firstly, the multiple, which is how much I paid for it, around 18.6. And then it was generating 47 cents at that point of time. Okay? So this is your starting point. Now your question is, what was driving the share price? Today, if you look at 126, you can break it down to two numbers as well. The first one is the multiple, which has actually not changed at all. So you can see that from the time I bought, which was 18.6, to today, there was actually no influence at all from the multiple itself. The multiple contribute nothing to the increase of the share price, right? So what was it which contributed to all of the gain? It's really the business, right? The business has actually increased by 14.4 times, and that was the main contribution for the entire gain in the stock price. And I think, ladies and gentlemen, this is what you want to focus on. Now, we're coming to a period of time where earnings per share and free cash flow per share may decline, multiples may compress, but this gives you a framework to know what is actually happening. Is it declining while your free cash flow per share is increasing? Or is it declining because the free cash flow per share was declining? But the main thing to remember is that over the long term, as I've shown you here, right, this is a gain which is after a 33% drop last year in the NASDAQ. You can still make extremely good gains if you focus on the right things. And with that, I'm going to be a panel later. I'm going to end our presentation now. And before I go, one last thing. We have Warren Buffett. There's this quote which ties everything very nicely. And he says that games are won by players who focus on the playing field and not on the scoreboard. And if you think about it, if you enter a stadium, you don't look at the scoreboard to guess where the price is going to go, right? Or where the score is going to go, right? You look at what's happening in the playing field. You look at how they're playing, and that gives you a sense, because guess what? Whatever happens on the playing field, the end ends up on the scoreboard.